Hi everyone and welcome to this video. So when it comes to stocks, everyone wants to buy low and sell high. But what usually happens in case of most of the retail investors is they end up doing the reverse. They end up buying high and sell at low prices. So what happens is that you buy a stock at 100 rupees and within a few days you realize that the same stock is now available at a price of 80 rupees. Similarly, let's say you sold a stock for 100 rupees. Within a few days, you might realize that the same stock could have been sold at a higher price, let's say at 120 rupees, and you have missed the opportunity to book a profit of 20%. Is there a way by which retail investors can minimize this? This is what we will discuss in today's video. And towards the end, we'll also discuss how a retail investor can spend just 2 minutes to make an optimized decision and actually end up buying low and selling high. Now the first concept that you need to understand is called the concept of mean reversion. What this simply means is that price of a volatile asset will always tend to converge towards its mean. So for example, if the stock price is currently here, then it is significantly above its mean right now, and therefore the concept of mean reversion will bring the price of the stock towards its mean. Similarly, when the price is much below its mean, the same concept of mean reversion will now try to push the stock towards its mean. So this means that looking at the current price of a stock and then comparing it with its 200-day moving average, which is its mean, can give good indicator to a retail investor on when to take entry or exit from a stock. The second metric is the RSI indicator or the relative strength indicator, which shows momentum of a stock. It shows whether a stock is overbought or oversold. So RSI value higher than 70 indicates that the stock is overbought and a trend reversal is likely to happen, which will drive the prices of the stock downwards. Similarly, an RSI lower than 30 indicates that the stock is oversold, and again a trend reversal could happen, which will drive the prices of the stock upwards. So let us now look at how we can use both these matrices together to understand the points of entry and exit for a retail investor. Now this is the chart that I have populated from tradingview.com, which is a free website. It has a premium membership also, but the chart that I have extracted is from the free version. And we'll use this to understand how both of these matrices can be used. So now on this chart, the red and the green lines basically indicate the daily movements of the stock. The black line here is the 200-day moving average, and the blue line at the bottom is the RSI indicator. So let's look at this chart and try to identify some of the good buying and selling points. Let's start with the selling point. Now for selling points, our condition was that RSI should be greater than 70, and second, the price of the stock must be higher than its 200-day moving average. Let's look at when these two conditions meet. Let's start with the RSI. Now if you see, at this point, the RSI is greater than 70. Okay. And the price of the stock in this zone is much higher than the 200-day moving average. So this is a good point to sell. Now, if you look at what happened in the stock later, you will realize that this theory stood right, because right after this point, there was a massive drop in the prices of the stock. Similarly, let's now look at some of the good points to buy. Now for buying decision, the RSI needs to be lower than 30 and the price of the stock needs to be lower than the 200-day moving average. Let's look at when these conditions are meeting. So if you now look at this point, the RSI is lower than 30 and the stock price is lower than the 200-day moving average. So is this a good point to buy? Yes, because immediately after this point, the trend gets reversed and the prices increase. Now if you look carefully at this chart again, you will realize that similar situation for right buying is getting created again. So in the latest trend, you will see here the RSI has again dropped to lower than 30 and the price of the stock has been trading below its 200-day moving average. So this basically indicates that based on the two matrices that we had just discussed in this video, it might be a good time to invest because the prices will revert to its mean and the investor can expect to get some good gains in a short period of time. Now, as we promised earlier, is there a way in which a retail investor can quickly investigate these things about a stock and make the right decision? The answer is yes. So there is a free website called topstockresearch.com, and on this website you can get all the tables and data about a stock without any charges. So for example, in the case of Nestle that we were discussing, all the metrics are available here. So the end of day share price and the two metrics that we discussed, the 200-day moving average as well as the RSI. So you can now easily compare the current price of the stock, the 200-day moving average and its RSI value, and arrive at a quick decision whether it is the right time to sell or buy a stock. So please note that you should do this analysis only for those stocks that are fundamentally solid and the stocks in which you wish to invest in the long term. For other stocks, this might not be the best practice to follow. Also note that predicting the price movement of a stock is next to impossible, and these techniques can only give you an indication of what might happen next. I hope you found this video informative, and this video would help you to make the right choices at the right time. Please do not forget to like and subscribe. Take care and see you in the next video.